I'm Sarah, a tutor here at Accountancy Learning, and in this video I'm going to take you through the Financial Accounts AAT Sample Paper 2 Task 5. So this task is about interpreting financial statements using profitability ratios. Our first part then is we need to identify which two of the following are considered primary users of final accounts. So we need to remember here what are primary users, and they're going to be the people that have a real vested interest in the business because there is some sort of financial element. So they're going to be our primary users. So we've got a list here of existing investors, employees, lenders, customers, and government. Now, all of these people, these are all stakeholders, but they're not all primary users. So we're looking for the ones that have a financial interest in the business. So existing investors, so they have put money into the business, so they are going to want to know how the business is doing. So they are going to be a primary user of final accounts. And lenders, so lenders might be a bank loan, something like that. They are also going to be primary users of our accounts because they have provided money to us. All the rest have an interest, but they are not primary users. Next, we are given some definitions, and we need to use these options over here to decide which accounting principle the definitions apply to. So sales revenue should be recognised when goods and services have been supplied. Costs are incurred when goods and services have been received. So this is matching. So this is matching our sales and our purchases to the time period to which they relate. So this is going to be an example of our accruals principle. So that means whatever time period we're working to, we make sure that we accrue and we prepay to put the costs in the relevant time period to which they relate. Financial statements are produced using the assumption that an entity will remain in business for the foreseeable future. So there's a key bit there, foreseeable future. So that means, is it going to continue going? Is it going to continue running and remaining in business? And if you notice, in those sentences I said there was a word going, because we're going to be talking about going concern. Is that business going to continue trading in the foreseeable future? Transactions and valuation methods are treated the same way from year to year or period to period. Users of accounts can, therefore, make more meaningful comparisons of financial performance from year to year. So we've got a couple of keywords here. So same way from year to year or period to period. And it then means that they can make more meaningful comparisons. So if we're treating things in the same way, it means that we are being consistent. So this is the principle. Consistency. And our last one here. Profits are not recognised until a sale has been completed. In addition, a cautious view is taken for future problems and costs of the business. They are provided for in the accounts as soon as there is a reasonable chance that such costs will be incurred in the future. So we're saying that we're not going to say we've made profit until the sale has been completed. We're having a cautious view for future problems, and costs of the businesses are provided for as soon as there is a reasonable chance that they will be incurred. So this cautious way of working means that, for example, when we do our doubtful debts, then it means we're providing for a percentage of customers that may not pay their invoices. So that means we are being prudent. So this is the principle of prudence. It's about providing. So if you remember provision, prudence, we've got the same P there. So it's doing provisions and making sure that we have that cautious outlook. Next, we need to identify whether each of the following statements about profitability ratios are true or false. The analysis of financial statements using ratios provides useful information when compared with previous performance or industry averages. So this is true. So when we have financial statements and we have the analysis using these ratios, it means that we can compare it either against previous performance from last year, 2 years ago, 3 years ago, or it can be compared against an industry average as well. So how is your business performing in the industry as a whole? An organisation's management will never use financial ratios to assess its performance. There's a key word there, never. Well, this is false because management will be using ratios to assess its performance because it's a good indicator of how the performance of the business is going. Ratios based on historical data can always predict the future performance of an entity. Now, yes, we can use ratios to help us forecast into the future, but we cannot always predict the performance because things change. So that one is false. Next, you are given the following information about an organisation. The statement of profit or loss shows the following figures, and we're given figures there for revenue, gross profit, and the profit or loss for the year. We're also then given some figures about the statement of financial position for non-current liabilities, current liabilities, and capital. We then need to complete the following ratios based on the information above. Show your answers to 2 decimal places. So we've got a bit of formatting here that we need to do to make sure we pick up our marks in the question. Return on capital employed. So we are going to be looking at what the return is on the money that's been invested in the business. So our return is going to be our profit. So that's going to be one figure that we're going to be using in our calculation. Then we need to have a look at what's actually been invested. So capital is one form of investment, but also non-current liabilities. So this is bank loans, things like that, that are payable back over longer than 1 year. So our non-current liabilities. So our calculation is going to be our profit. And then we're going to divide that by the sum of what's been invested. So our capital and our non-current liabilities. And then because we are working to a percentage, we multiply it by 100 and we get 59.3005. We want it to 2 decimal places. So our answer will be 59.30. Our net profit margin then. So for this one, we are going to be taking our profit figure again. We're going to be using that. And we're looking at what our net profit margin is. So we're going to be basing that on our sales revenue. So what's our margin on our sales? So we will do our profit. We're going to divide it by our sales, so our sales revenue there, and then multiply that by 100. which gives us 18.49133. So again, 2 decimal places. We need to make sure that we do our rounding properly, so we are going to round down to 18.49. So next then, you have already calculated the selling expenses revenue percentage for the current year as 15.6%. The corresponding figure calculated from last year's accounts was 13.2%. Complete the following statement. The selling expenses revenue percentage shows, and we've got to say, is it an improvement or a deterioration when compared to the previous year's figures? So we're looking at selling expenses and revenue. So this is how much as a percentage does the selling expenses take of the revenue. So last year it was 13.2 and this year it's 15.6. So the percentage has increased. So what does that mean? So 13.2% of revenue was selling expenses last year, but this year that's gone up to 15.6% of our revenue is selling expenses. So if our costs then have gone up, so that says our costs have gone up, our expenses have gone up, it means that there is a deterioration when compared to last year's figures. Next, identify what effect, if any, each of the following scenarios may have on the ratios stated. Each scenario is independent, so we're looking at these without any connection to the other. Your company has managed to negotiate a lower price with a main supplier of your inventory. This has not affected the quality of goods you receive. So we're going to be looking at return on capital employed and cost of sales as a percentage of revenue. So if the lower price has been negotiated, this means lower costs. So if we've got lower costs, it means that we will have higher revenue. We will have higher profit, my apologies. Because we're not spending as much. So lower costs will be higher profit. So the higher profit part of it means that when we're looking at our return on capital employed, it means that we're going to have a higher return. We're getting more profit back on what capital has been employed in the business, what investment there is in the business. So that means we're going to have a better return on capital employed. Our cost of sales is a percentage of revenue, so our lower costs might mean higher profit, but it also means that the percentage of the revenue is going to be lower. So our cost percentage of revenue is then going to be lower. So that's going to decrease. And then scenario 2. The wage rates of administration staff have risen in line with others in the industry. The amount and skills level of the labour has been unaffected. So now we need to look at gross profit percentage and net profit percentage. That's really important that you do understand the difference between the two. So our gross profit is our revenue minus our cost of sales. And our net profit is our gross profit minus our operating expenses. So gross profit percentage is only concerned with revenue and cost of sales. Now, the admin staff is not part of cost of sales because it's not involved in the cost of actually producing what it is that we sell. So therefore, our gross profit is going to be unchanged by this pay increase. However, our net profit percentage will decrease because our operating expenses there, so those wages for the admin staff will be part of our operating expenses, they are going to go up. So that means from our gross profit, there is more operating expenses and therefore our net profit will reduce. And that brings us to the end of task 5.